Welcome everybody, thank you for joining me today. And in the hot seat, as it were, is Chris Hutchinson, a Director of Unicorn and Lead Manager on the Unicorn AIM VCT. Chris, lovely to see you.
Likewise, Lawrence, always a pleasure.
Now, in my extensive research for this interview, I mean, one of the things that sort of struck me is that the Unicorn AIM VCT is actually, by assets under management, the largest of the VCTs focused solely on AIM. Is that important in terms of the assets under management to investors?
Well, size matters occasionally. We have grown, or the growth of the VCT is a result of clearly the support that we've had from shareholders in various offers over the years, but more importantly perhaps that we've been able to build out a very healthy collection of really powerful businesses that are generating profits and cash and paying dividends in many cases, and therefore the growth has been a result of a number of very successful investments. We're not obsessed with size. Size for me always comes as a result of doing the right things, and that's a healthy outcome. And we're not also entirely focused on AIM. We've always been AIM focused, but we've got half a dozen investments in privately owned businesses, two of which have been phenomenally successful in recent years and which have helped deliver that asset growth, which sets us up very nicely for the future. It means that we've got a really solid base from which to deliver further growth over the next decade and beyond.
Lovely. Now, for people who are not familiar with the VCT, what kind of businesses do you invest in? Not clearly, most are listed on AIM, but as you said, there are some private businesses. But what are the types of businesses historically you've liked for this VCT?
We've adapted over the years. The rules have changed on numerous occasions surrounding what constitutes a VCT qualifying company. So I'll answer this in two parts. In the old days, I'm old-fashioned, and I used to love the idea of only investing in established, profitable businesses at the point of investment. To me, a very simple approach is to try and find proper businesses that sell products and services that their customers really need and that they get a real benefit from. So in the 16 odd years that I've been doing this, for the first 10 roughly, was all about trying to find those kinds of businesses. They happily, in that period, have many of which have grown very substantially. And that gives us a core portfolio of strong, healthy, financially and operationally healthy businesses that are mature and that still have growth potential. That underpins everything. And then in the last few years, the rules tightened again, such that we are now focused entirely on early stage scale-up businesses. We now look for businesses that have got an established revenue stream, but which typically will not yet have achieved profitability. And so if you take those two things in context, the core of the portfolio with these established and maturing businesses helps us with confidence that we can continue to perform, with the ability to generate investment income from the underlying dividends received from those investee companies. And then with the new ones, I like to think of those as a bit of a nursery, that clearly the risk profile is higher, but we don't have to allocate enormous amounts of capital, nor is future performance dependent upon their success. I'm happy to say that in recent years, partly because AIM's been back in favour and partly because we've hopefully had a reasonable success rate in choosing good businesses in those early stage scale up areas, they have also made meaningful contributions to performance. So what we've now got is a really interesting situation where real diversification across many different sectors, not dependent upon performance on any one or two companies within the portfolio, over 80 qualifying companies in total, and with serious growth potential amongst some of the newer investments. So always dangerous to say this because I work on the basis that my bottle is either empty or very nearly empty, and that way I can manage my own expectations and those that entrust their money to the fund. But I do think we're nicely placed to continue delivering really healthy capital returns, and over time continuing to grow the underlying investment income such that, you know, overall the total returns ought to continue to be able to beat that of the main UK indices. And, you know, hopefully, although we don't spend a lot of time worrying about what the competition are doing, hopefully deliver best-in-class performance when measured against them as well.
Okay, lovely. Now we'll sort of talk about the new share issue in a couple of minutes. But again, one of the things when I was doing my kind of research, I mean, I noticed portfolio as at the end of March, so, you know, clearly sort of kind of best part of 9 months out of date, but the top 10 holdings counted for about 48% of the sort of trust's value. Should people read anything into that?
Well, that's an excellent question, Lawrence. At the end of September, it was nudging up towards 50%. It echoes, echoing what I previously said. If you look at those top 10, there are a couple in there that are yet to achieve profitability, but have been successful nonetheless in share performance terms. But the majority, eight of them, are really strong businesses. Two of those are privately held, and there are things happening with both of those that would suggest that within a year or so we'll either have a capital return situation, or with one of them we're hoping that they will list on AIM, so that we get back into kilter with that real focus on AIM companies. But no, they're all, what you read into it is that that's taken a long time and that they've become successful, and that now has all the hallmarks of a really solid smaller companies investment trust based on investing in UK businesses, but with all the tax attractions of venture capital trust. And on top of that, this growing pool of assets in early stage businesses, not all of whom will be successful, but those that are will then over time join that top 10, and in the process have delivered considerable contributions to performance.
And should I also read into it that you're patient as investors? Because I think, again, looking at that sort of top 10, you've been invested in quite a few of them for a good period of time. Is that patience?
Yes, patience is a commodity that is partly in short supply in the market generally, and absolutely necessary in venture capital investing. Taking the example of Abcam, when I first joined Unicorn, it was one of the first investments that I was involved with on the VCT. We invested in it at late 2005. It was a £50 million company at the time. We've held it consistently in the VCT throughout that intervening 16-year period, and it's going to become a £4+ billion company and a world leader in the distribution and sale of therapeutic antibodies across the globe. It is genuinely an international and a hugely successful business. That has taken patience. They have had hiccups along the way, but it's a shining example of what can be achieved through this whole venture capital structure if one applies the necessary level of patience. And we are long-term investors. I typically look to hold investments in the venture capital fund for a minimum of 5 years, and preferably 10, 15 and 20 years. So we're very pleased to adopt that approach. It does mean that exits are few and far between, and it also therefore means that, unlike most generalist VCTs, we don't deliver a significant proportion of our returns to shareholders via special dividend distributions. Although you probably noticed we have actually announced our first ever special dividend, which is 7p to existing shareholders, coming up to be approved and to be paid in early next year. And that's a result of one of our mature businesses that was extremely profitable, but where we'd had to be incredibly patient. We'd had many problems along the way. It was a business called Augean, a specialist hazardous waste disposal business, but it's been bought by a trade buyer. It's delivered a massively healthy capital return to us, and we have decided to distribute all of the capital profits from that exit to shareholders in the form of that 7p special dividend. And what I would say is that just to finish on that, the result of that patience is that I think in coming years, investors should look towards, albeit unpredictable, albeit still quite occasional, a greater frequency of those types of events which might lead to further special dividend distributions going forward.
Interesting, and we'll discuss the dividend track record in a couple of minutes. You mentioned obviously you have some exposures to sort of unlisteds, some of them quite significant positions within the sort of trust. How do you approach the kind of the unlisted market? Because again, you know, it's for some people, you know, it can be perceived as a sort of high risk space. When do you decide to put a private unquoted business into the portfolio?
It depends on circumstances, and the circumstances currently are that 2 out of the 6 unlisted investments that we currently hold have been very successful and sit in positions 1 and 2 in terms of their contribution to assets. And we have therefore, over the last couple of years, decided to step away from making further unlisted investments, because otherwise we're going to lose that focus on AIM. And it's interesting because they have, those 2 businesses in particular, have matured significantly, and events that might lead them either to be listed on AIM in future or be acquired. One of them is already in the process of being acquired, hopefully. That means we will get back to that traditional AIM focus. We will solve the inherent liquidity risk involved in investing in unquoted, and we will then, if those 2 do the things that I'm hoping, we will then be in a position to recommence looking at selective private investments, and that will always be by exception. It is always governed by the necessity for me to be confident that there is a clear path either to IPO or to a trade exit within a defined period of time, typically, hopefully less than 3 years. Our existing unlisted businesses, it's fair to say, have taken quite a lot longer than that to get to that point, and that again touches on your point about patience. But it's a nice position to be in. We're very happy with the development of that unquoted portfolio, but as I say, we haven't done any new ones for a number of years now, and we won't do any more until the top 2 have resolved our slight but happy problem on liquidity and the focus on AIM.
So we've talked about dividends already, and you've kind of mentioned a special dividend has been declared and will be paid early in 2022. Again, noticeable, the dividend policy since 2017 has been sort of 6.5p per share, sort of very, very steady, consistent, reliable. How have you managed to achieve that? You know, particularly as you said, you know, the trust has not made a huge number of exits compared to some of its peers.
Yeah, so again, really pertinent point. We have a number of tools at our disposal. The first of which is that we always take a prudent and cautious approach to building the reserves available to distribution. We've currently got around 100 million of assets available for distribution. It makes no sense to anyone really to do that in big lumps. Our shareholders, judging by the feedback we get from them, are very comfortable with the approach. They're very keen on that steady, consistent, and reliable tax-free dividend income stream that they've been getting. It is harder to grow that per share distribution on an annual basis than it used to be because of the success in capital growth. And also the success of the offers. We now have almost 150 million shares in issue, which means that 6.5p represents about 10 million of annual dividend payments being made to shareholders. And we have to balance all those various elements to be certain that we can sustain that dividend income stream into the future. And that's a sort of overview of how we approach it. And then if we're lucky enough from time to time to get these exits, then we have a choice as to how we tackle that excess return of capital profits. Partly that will be done in the form of those distributions made back to shareholders. Partly those capital profits will go into the capital reserve for future distribution. And some of that capital will be used to recycle into new qualifying investments in order to keep that whole cycle turning in future years. And it's there are a number of spinning plates that have to be kept spinning at all times. But once you've cracked it in that sense, you then have a great deal of confidence in the ability to continue paying that sort of underlying and reliable and consistent income stream.
Now, one of the other things that the VCT did in early 2021 was introduce a dividend reinvestment policy. What was the thinking behind doing that?
Yeah, well, I think it's been in place since 2019. We were a little slower than some of the other VCT providers in terms of giving that option or making that option available to shareholders. It has been tremendously successful. There's about a third now of shareholders, possibly a bit less than that, who are taking up that option. And what that allows them to do, obviously, is to get a little bit more extra upfront tax relief by investing their dividends in new shares. It also helps them provide, access and build upon their existing stake in the company and its underlying investments. And it's been very popular. So I think the real answer to it is just to make sure that we're thinking about and providing as many attractive options to our investors as are available. Now, it'll be interesting to see what the uptake is, because it's going to be available as an option on the special dividend as well. So we'll know more come the payment time for that. But I do think there is a recognition now amongst the 8,000 strong shareholder base that actually they quite like what's going on within the VCT, under the bonnet, as it were. And actually, if they can find a tax efficient way of owning a bit more of it through the dividend reinvestment scheme, then they're very pleased to do so.
And I know from talking to a number of advisors and private investors, the sort of reinvestment programs are becoming kind of more popular with the more mature sort of VCTs. Just kind of moving on, what do you think the VCT offers that perhaps some of the other unicorn funds that the group has got, particularly on the open-ended side, sort of doesn't offer?
Well, I have always regarded the VCT as an incubator for our other funds and as the most appropriate vehicle for accessing early stage businesses on day one of their quoted life. And that's been tremendous, because whilst we will have our fair share of failures, and I'm afraid I've had many over the last 16 years, and each one hurts me as much as the last, and we're trying to avoid those ones because they have an extremely detrimental impact on overall performance in the end. If your investment goes to zero, then there's no coming back. But what it does do is it means that we get to know the management teams of those businesses extremely well over a number of years in their early stages of their development, help them mature, help them avoid the obvious pitfalls of being listed, give them advice where necessary. We're passive in terms of not seeking investor director representation on the boards of these companies, but I also like to believe that we're highly supportive. We meet them all at least twice a year wherever possible. We get to know the management teams extremely well, and those that do become successful are ideal candidates for migration, or at least not migration. That implies that we're selling them out of the VCT and into the open-ended funds, but for additional investment, perhaps when they're no longer, they might need a fundraise and they're no longer VCT qualifying. They become an ideal candidate if they're raising money for the right reason. Then our open-ended UK smaller, UK growth funds, they're ideal candidates for inclusion in those types of funds. So it's a happy balance really between all of that. And by the time they become suitable for potentially being included in those open-ended funds, we have what I would describe as a real competitive advantage amongst institutional investors, because we've been owning that business in the VCT for many years, and we've got to know and trust and respect and understand what management are trying to achieve.
No, that makes a huge amount of sense. Now, back in October, you kind of announced that there was going to be a new share offer. I think the prospectus is published in sort of early January. I think the figure is around sort of £25 million new shares that are intended to be issued. Sort of two questions really off the back of that. Will there be an over allotment sum as well? And over what period of time would you expect to deploy that new money raised, particularly as you know, you may well be, the trust rather may well be a recipient of a couple of big sort of payouts from some of those deals that you kind of mentioned earlier with the portfolio?
You're on fire today, Lawrence, hitting me with all the right questions. The total amount we are seeking to raise is 25 million. It's exclusive to the current tax year. We have put in place a short priority window for existing shareholders to enable those that have supported us over many years to access this current offer. There will be no over allotment option. We have sought to really control the amount of capacity here on the basis that whilst the market is healthy and demand is healthy and capacity generally is growing, we're very mindful of the fact that we want to deploy that new capital in a productive sense and in a selective way to ensure that we're picking the best of what is available amongst the VCT qualifying companies that we see. And if you do the maths on that, it's pretty simple. We have 12 months from the end of an accounting period, i.e. the end of the company's financial year, in which new money has been raised in order to invest 30% of the money that has been raised. That's a new rule that came in a couple of years ago. And of course, it's designed to ensure that the money is being invested within a defined period of time and is being targeted at those businesses that are truly scale up and need the capital and can't easily access capital from other sources. So HMRC and the government have got this end of things absolutely right now, in my view. It's targeted at the right early stage areas. And so what we do is we work out very simply, because I'm not as much of a mathematician as I could be, Lawrence, despite perhaps being better at maths than you. Roughly speaking, within that 12 month period, we're looking for 3 investments at around the £3 million mark, which would give us £9 million invested in the first 12 months, which is well over the 30% threshold. In other words, manage the amount that you're seeking to raise with the amount that you can actually sensibly get deployed. And that, to me, will always be my guiding mantra. We are in control of that capital tap, and we'll turn it off if we think valuations are getting too racy, if we think the quality or the quantity of investment opportunities isn't sufficiently good, and that is entirely at our discretion. I'm sure, you know, if we put a massive marketing push behind it, we could probably raise 4 times, 5 times, 6 times that amount, who knows. But it would compromise our ability, in my view, and others may think differently, but in my view, compromise our ability to successfully and sensibly invest that new capital. That's our guiding principle, and that's what we've always stuck to. We know and understand that there are a lot of people who quite like what we do and what the VCT sector in general is doing. And I do think right now demand probably exceeds supply. I had heard that overall supply this year is going to be quite close to £1 billion. Now that money does have to find a home, and we are very mindful of the rules, very complex and very clear, complex but clear rules about what you can invest and how much you can invest. And so we're just simply trying to make sure that we match what we can raise with what we can sensibly invest.
So I guess a case of size does matter in this case, and the bigger the raise, not necessarily the better the outcome for investors over the long term. And clearly, Chris, your sums are a lot better than mine. My track record currently on the maths front's not so hot. So let's finish with sort of just a general kind of market question. I mean, Unicorn is quite rightly well respected as a UK equity house. The kind of UK market still feels a little bit unloved, sort of, to me. I mean, we could probably go back to, you know, the initial announcement of sort of Brexit 2016 for the start of that sort of falling out of love with the sector. Why would you argue it's still a great place to be invested?
Well, partly because it is relatively undervalued compared to other equity markets around the world. Partly because this country has always delivered huge innovation and entrepreneurial spirit, and that spirit and of innovation and entrepreneurship is being encouraged now by the government and by the success of the VCT sector in general. I think there's a recognition that both technology and climate change need to be coupled together to find solutions, and therefore what we're seeing is a really interesting and unusual coalescence of factors, which means that those people with innovation, with vision, with an idea, with a solution, they're coming to the market with a highly targeted, very specific approach to a particular problem that can not only in many ways solve or help solve some of these really pressing climate issues and environmental issues, but also deliver efficiency, productivity, and greater opportunity for profitable growth for their customers, and that's fascinating. I'm not a huge fan of the rate of change in technology, because at 59 I find it all a little bewildering, and even simple things like getting the camera set up on this screen properly often defeats me and frustrates me. So my approach is, let's hire and employ people who are much younger, much harder working, and much more intelligent than me, and much more familiar and embracing of technology. And then let's go out and find those businesses that we can help by injecting really early, really important early stage capital, and then nurture them through so that they can become the real success stories of the UK over the next decade or so. Now, you know, that sounds like quite a grand statement, and we will never change the world, and nor will we be seeking to invest in the kind of Elon Musk type business, which is so visionary as to be borderline insane. We're looking for very specific, very targeted solutions to very pressing problems, and that's the encouraging thing that I'm seeing, is that we're getting more and more of those businesses looking at AIM, saying, well, we thought it was a pioneer town in the Wild West where you're a scout if you weren't really very light on your feet, and actually it's changed hugely. It's full of these businesses that I'm referring to. It's being regarded as a real dynamic growth market that is attracting more and more serious entrants. It's got some hugely successful businesses at the larger end of the market cap scale, still on AIM and still being hugely successful. And actually, it's thriving. And you get the added bonus of being able to access those businesses at still reasonably sensible valuations. Now, will that last forever? Typically, what tends to happen is money comes into the market, indices perform well, more companies are attracted, brokers realize that they can earn good fees by listing these companies. They then take their eye off the quality ball and will start bringing companies to market that are of less obvious quality, but at much higher valuations. We're not seeing any evidence of that at the moment, but we're extremely mindful that that might happen, at which point we'll stop playing the game for a bit and go very much back to focus, not back to, but very much focus on what we've got within our portfolio. But I'm encouraged by the ongoing maturing process that I've witnessed on AIM. A few years ago, 40% by value of AIM was in somewhat speculative junior mining and oil and resource exploration companies. That figure's declined massively. We've got very good exposure to very specific targeted life sciences and biotech type businesses that are trying to address very specific problems. We've got great exposure to the software and computer services sector, accessing that technology angle that I was talking about. And we've also got representation across 23 sectors in total, with some fascinating businesses doing some wonderful, innovative, and really helpful stuff. So I'm not prone to bouts of irrational enthusiasm, but I am quite happy with the direction of travel at the moment. And just to put that in context, I was a little bit worried last year when we raised some money on the previous offer, but we were successful in making 12 new qualifying investments in the last financial year to the end of September. We invested about 30 million of new money into those qualifying companies, and pretty much a couple of them didn't work out quite as I'd hoped, but the rest of them have actually done really well, and that gives us an opportunity to take a little bit of money off the table through partial disposals to hopefully get back the initial investment cost, and then run the remainder of that holding without excess risk, and whilst at the same time topping up our capital reserves for future distribution by way of dividends to shareholders. So it's working well at the moment. Whenever I tend to say things are working well, something comes along that is external, that kind of makes the whole premise of the argument unravel. And I'm sure that'll happen again. Can't tell you when or why, but I do think the UK market's looking particularly healthy and interesting at the moment for the reasons described.
Perfect. Chris, great way to end. As you say, markets go up and markets go down, and something always comes along. But in the long term, if you're patient enough with the right companies, you should have a good outcome. Good luck with the fundraise for the VCT, and thank you very much for your time today.
Lovely to see you, Lawrence, and many thanks for arranging.